Okay, day 3, and we're going to look at what success looks like with property investing. Now, this case study is from Wadestown in Wellington. My brother's name's Wade. He's just moved to Wellington. You may have guessed that I picked this case study up not just because of the numbers, but because it means something to me, and I like to remember it when I'm comparing the deals that I'm looking at with this particular one. So this property was purchased at a discount. Now, what does that mean? That means that maybe the desktop valuation or a market valuation was giving it a price, and this purchaser was able to pick this property up at a discount. Might have been 20 grand, might have been 50 grand, might have been 100 grand, but you're going to see how much impact that has. Now, the purchase price was 810,000, and then the buyer went and spent $160,000 on renovations. Now, why would they do that? Well, the property would have been in quite a state, and it is quite a big property. So $160,000 of renovations, you can do a lot with that. You can do structural things, you can add things, you can take things out, you can change that aesthetic quite a bit. But the important point now is that we look at that. That's a $977,724 purchase price and cost, including the holding costs and the legal fees. Now, after this property was purchased, it was valued after the renovations at $1.1 million. So that is a $122,000 gain in a matter of months, just time enough to do the renovations. And the rental income generated from the property after everything was fixed up is $1,650 a week. So you can see it's quite a big property, lots of bedrooms. And what we've done through the calculations that we're going to look at all of the numbers a little bit closer is we've factored in a 5% vacancy rate. So you can change that up and down, but I think in Wellington, strong rental market, 5% vacancy is relatively fair. And what this purchaser did was mortgage the property up to 80% of the valuation at 2.65%. So this is a case study that's a year or two old, but the strategy of mortgaging up to 80% is totally fair, and once you understand and you look at more property case studies, you'll see that that is the way to go. That would be on interest only lending as well. So let's take a look at the numbers. Now, at like a bit of a deep dive, the numbers we really want to know about with property investments are cash on cash return, gross yield, mortgage coverage, which is a topic that we're going to cover in a lot more detail throughout the course, and net yield. Now, net yield is the return that you're getting after all the expenses. And what most people are really keen to know is how much surplus cash they're going to get each year. So that's net income. And what I've included in here is a 10-year gain figure, and that's very conservative. So what has this property brought the purchaser? A cash on cash return of 36.83%. So basically 37% return on their cash by investing in this property and doing the improvements they have. Their gross yield is 8.82%, mortgage coverage 9.75%, and as you see when we get to mortgage coverage as a topic, if we're getting this mortgage coverage number up to around 10.5%, that's when owning this property actually doesn't bring your borrowing power down. And if we get the mortgage coverage up, then owning the property actually increases your borrowing power. Net yield 5.22% after the top up, so that's when the property's basically fully leveraged. And the net income, so this property is producing $34,000 of income after all expenses to the owner. And what I did is I actually, and you'll see when I put the email in the description below, I used a 2% capital gains, and I factored in the income and the gains, and in a 10-year time frame with relatively little effort because the property's already been renovated and it's got a property manager. This property is going to make the owner well over $500,000 of gains. Remember, that's 2% capital gain I factored in. All the while, they can redeploy this surplus into paying down the debt if they want, or they can put it into other properties. They can use an offset. This property is a really super investment, and it's not hard to copy. What you got to do is understand capital gains, cash flow, capital improvement, and then have an eye for spotting a deal. So you've got to learn whatever you need to learn on how to spot a deal, if that's looking at 100 listings, going to 20, 30 open homes, working with your handier friends if you're not one of those people, figuring out costs of renovations. But you can see the number that I really like the most is this cash on cash return. There's not many things out there in the investment world that will give you a cash on cash return up around 37% in such a short time frame with the relative safety of residential property. So if you've got any questions about the numbers, let us know in the comments below. Read the full description, and as these 21 days unfolds, you start to learn a lot more about the numbers.